You're watching what might be the most shocking reversal in Chinese economic policy in decades. Right now, as you're watching this video, China's government just made a move that nobody saw coming, and it could reshape the entire global economy. I'm talking about the three red lines policy, the very rules that triggered one of the biggest real estate collapses in human history, and Beijing just quietly killed it. But here's the thing that's going to blow your mind. This might be way too late to save what's already broken. Hit that like button and subscribe because what I'm about to show you connects directly to your wallet, no matter where you live on this planet. Let me paint you a picture of what just happened. On January 29, 2026, Chinese real estate stocks went absolutely bonkers. China Vanke, a company that was literally days away from defaulting on billions in debt, jumped 10% in a single day. Country Garden Holdings, which had become one of the world's biggest money losers after its spectacular collapse, rallied 26%. Why? Because Cailian Press, which is basically the mouthpiece of the Chinese government, dropped a bombshell. The three red lines policy is dead. Gone. Finished. The very rules that were supposed to save China's property market by controlling developer debt just got thrown in the trash. Now, if you're sitting there thinking this is just some random Chinese policy change that doesn't affect you, let me stop you right there. China's property sector isn't just big, it's absolutely massive. We're talking about an industry that accounts for roughly 25% of the entire Chinese economy. To put that in perspective, that's larger than the entire economy of countries like Spain or Australia. 70% of Chinese household wealth is tied up in real estate. When I say 70%, I mean if you're an average Chinese family, 7 out of every 10 yuan you own is locked up in property. So when this sector crashes, it doesn't just hurt developers, it crushes consumer confidence, it destroys household wealth, and it sends shockwaves through the entire global economy. Let's rewind to August 2020, because that's when this whole disaster started. Picture this. China's property market was on fire. Prices were going up, up, up. Developers were borrowing insane amounts of money, building like there was no tomorrow, and everyone was making a fortune. But the Chinese government looked at this and saw a ticking time bomb. So they created what they called the three red lines policy. Sounds ominous, right? That's because it was. Here's how it worked, and this is absolutely critical to understand. The government set three specific financial thresholds that property developers had to meet. First red line, your liability to asset ratio, excluding advance receipts from pre-sold apartments, cannot exceed 70%. Second red line, your net debt to equity ratio must stay below 100%. Third red line, your cash must be at least equal to your short-term debt. Basically, you need to have enough cash on hand to pay what you owe in the near term. Now here's where it gets interesting. The government didn't just say, meet these requirements or else. They created a color-coded system that sounds like it came straight out of a video game. If you met all three requirements, you were green. You could increase your debt by up to 15% per year. If you crossed one red line, you turned orange, and you could only increase debt by 10%. Cross two lines, you became yellow, and you were limited to 5% debt growth. But if you crossed all three red lines, you went red, and you were banned from taking on any new debt whatsoever. Zero. Nada. Nothing. When this policy launched, do you want to know how many major Chinese developers could meet all three requirements? Out of over 200 major property companies, only about 6%, that's right, 6%, were in the green category. The vast majority of China's biggest property developers were either orange, yellow, or blood red. Companies like Evergrande, which was the world's most indebted property developer with over $300 billion in liabilities, didn't stand a chance. Country Garden, Sunac, Kaisa. Basically, every name you'd recognize in Chinese real estate was in deep trouble from day one. But here's what the government was thinking. They looked at this massive bubble and said we need to deflate this slowly and carefully before it explodes in our faces. The idea was that by forcing developers to deleverage, to reduce their debt loads, they would make the industry more sustainable in the long run. Houses are for living in, not for speculation. That was Xi Jinping's mantra. Sounds reasonable, right? The problem is, they didn't just let the air out of the balloon slowly. They basically took sledgehammer to it. Almost immediately, everything started to fall apart. And I mean everything. See, Chinese property developers had been operating on what's called a high turnover model for years. Here's how it worked. They would buy land using borrowed money. Then they'd pre-sell apartments that hadn't even been built yet, collecting cash from buyers. They'd use that cash to start construction, but also to buy more land and start more projects. It was a perpetual motion machine fueled by debt and pre-sales. As long as property prices kept going up and people kept buying, it worked beautifully. But it was also incredibly fragile. The three red lines policy smashed this model to pieces. Suddenly, developers couldn't borrow new money to keep the machine running. Banks were instructed to limit funding to firms breaching the debt thresholds. And get this, creditors started demanding prohibitively high yields to lend more money. We're talking about interest rates of 10% or more on dollar-denominated bonds. For context, that's the kind of rate you pay when people think you might not pay them back. By mid-2021, the liquidity crisis hit like a freight train. Developers couldn't roll over their existing debt, meaning when old loans came due, they couldn't get new loans to pay them off. Cash reserves started plummeting. And here's the really scary part. These companies had already pre-sold apartments to millions of Chinese families. They had taken people's money and promised to deliver finished apartments. But now, they didn't have the cash to complete construction. Enter Evergrande, the poster child for this entire crisis. In late 2021, Evergrande basically admitted it was broke. The company had liabilities exceeding $300 billion. $300 billion. That's more than the entire GDP of countries like Finland or Chile. They stopped making payments on their offshore bonds, they missed interest payments, and by December 2021, they officially defaulted. Fitch Ratings declared them in restricted default, which is basically the financial equivalent of putting a corpse on life support. But Evergrande was just the beginning. The defaults started spreading like a virus through the sector. In 2021 alone, nearly 47 billion yuan worth of real estate bonds defaulted, accounting for 29% of all defaulted bonds in the entire Chinese market. That was a record. By 2022 and 2023, the situation got even worse. Company after company started toppling, like dominoes. Then came Country Garden, and this one really shocked people. Unlike Evergrande, which everyone knew was ridiculously over-leveraged, Country Garden was supposed to be one of the safe ones. They didn't borrow as heavily as their competitors. They focused on building affordable homes in smaller cities. The Chinese government literally called them a model developer. Officials held them up as an example of how to do things right. In 2023, they were still generating $64 billion in revenue. That's billion with a B. But in August 2023, everything went sideways. Country Garden warned of a massive loss for the first half of the year, somewhere between $6 billion and $7 billion. They missed interest payments on $2 bonds, totaling about $22.5 million. Now, $22 million might not sound like much for a company this size, but it was a clear signal. Even Country Garden couldn't escape the crisis. By October 2023, they officially defaulted on an offshore bond for the first time in the company's history. Here's what made Country Garden's collapse so terrifying. This wasn't some reckless developer that had gone crazy with debt. This was a company that had 3,000 projects across China. They had converted over 1,400 rural towns into cities. They employed 70,000 people at their peak. They had developments in basically every province. If Country Garden could fail, it meant nobody was safe. And the fear that spread through the market after their default was absolutely justified. Bloomberg intelligence analyst Christy Hung put it perfectly. She said any default at Country Garden would impact China's housing market more than Evergrande's collapse because Country Garden had 4 times as many projects. Think about what that means. 4 times as many construction sites. 4 times as many families waiting for apartments. 4 times as many suppliers and contractors depending on payments. 4 times as many local governments relying on land sales to these guys for revenue. The ripple effects were absolutely staggering. Now, I need to tell you about what happened to regular Chinese people during all this, because this is where the human cost becomes really clear. Imagine you're a family in China. You've saved for years, maybe even decades, to scrape together enough money for a down payment on an apartment. In China, you typically need to put down 30 to 40%, sometimes even more. So we're talking about your entire life savings. You find a nice new development, you sign the contract, you hand over your money. The developer promises to deliver your finished apartment in 2 or 3 years. But then the developer runs out of money. Construction stops. Your apartment is sitting there half finished. Maybe it's just a concrete shell. Maybe they haven't even poured the foundation yet. And here's the kicker. In China, you start making mortgage payments as soon as you sign the contract, not when you move in. So you're paying a mortgage every month for an apartment that doesn't exist and might never be finished. You can't live in it, you can't sell it, and you can't get your money back. You're just stuck. This happened to millions of Chinese families. Millions. By 2022, there were widespread mortgage boycotts where home buyers simply refused to keep paying for apartments that weren't being built. Can you blame them? The social unrest this created was serious enough that the government had to take notice. People were protesting at Evergrande and Country Garden headquarters. The political instability was becoming a real problem for Beijing. And it wasn't just home buyers getting crushed. The entire economic ecosystem around property development started collapsing. Construction workers lost their jobs. Suppliers of building materials weren't getting paid. Banks that had lent money to developers were sitting on mountains of non-performing loans. Local governments that depended on selling land to developers for revenue suddenly saw that income stream dry up. Some estimates suggest that local governments in China get up to 43% of their revenue from land sales in smaller cities. When developers stop buying land, that revenue disappears. The macroeconomic damage was brutal. New home sales in China fell like a rock. In 2024, total sales volume dropped to 814.5 million square meters, a decline of 14.1% year over year. Property investment plummeted nearly 16% in 2025. Home prices kept falling month after month. By November 2025, new home prices across 70 major Chinese cities had dropped 2.4% year over year. That was the 29th consecutive month of price declines. 29 months in a row. And here's the thing about falling property prices in China that makes this so much worse than a normal market correction. Remember, 70% of household wealth is in real estate. When property values drop 20% or more from their peak, which is what happened in many cities, Chinese families feel drastically poorer. This creates what economists call the wealth effect. When people feel poor, they spend less. When they spend less, consumption drops. When consumption drops, the entire economy slows down. China's GDP growth, which had been chugging along at 7 to 8% for years, started slowing noticeably. In 2024, growth came in around 5%, which doesn't sound terrible until you realize that China needs much higher growth to create enough jobs for its population and to service all its debt. By 2025, projections suggested growth would slow to 4.5% or even lower. For an economy that's supposed to be catching up to developed nations, that's concerning. The deflationary pressure was getting scary too. The consumer price index in China was barely positive. The producer price index, which measures wholesale prices, was actually negative for over 20 months straight. When you have deflation, people delay purchases because they expect things to be cheaper tomorrow. That further reduces demand, which pushes prices down more, which makes people wait even longer to buy things. It's a vicious cycle that's really hard to break. But let me tell you about China Vanke, because this is where the story gets even crazier and brings us right up to today. Vanke was supposed to be bulletproof. This company was founded in the 1980s in Shenzhen, right at the heart of China's economic miracle. They became one of the biggest, most respected developers in the entire country. They had over 120,000 employees. They were partially backed by state-owned shareholders, including Shenzhen Metro Group. If any company was too big to fail, it was Vanke. But in late 2025, even Vanke started to crack. In November, they proposed delaying repayment on a 2 billion yuan bond. Their dollar bonds plummeted to 23 cents on the dollar, down from near 80 cents just months earlier. In December, they faced another bond payment of 3.7 billion yuan. Bondholders had to vote on whether to extend the deadline or force Vanke to pay up. The vote to extend by 1 year failed. It needed over 90% approval and only got about 20%. This put Vanke in an absolutely desperate situation. They had a tiny grace period to come up with the money or face default. And remember, this isn't some minor company. Vanke had about $50 billion in total interest-bearing liabilities and only about 8 billion in cash against 151 billion yuan in short-term debt. The math didn't work. Multiple rating agencies downgraded them to selective default or restricted default. In December 2025, they barely managed to scrape together enough to avoid an immediate default, but it was clear they were on borrowed time. The fact that even Vanke, with state backing, was struggling this badly sent a chilling message to the market. If Vanke falls, the thinking went, then literally no developer is safe. The entire sector could be facing systemic collapse. And that's when Beijing apparently decided enough was enough. They couldn't let the 3 red lines policy destroy the entire industry. Something had to change. Which brings us to January 29, 2026, and the stunning announcement that the 3 red lines are being dropped. Now, let's be crystal clear about what this means and what it doesn't mean. The government is essentially admitting that the policy failed. It didn't create a gradual, controlled deleveraging of the property sector. Instead, it triggered a catastrophic liquidity crisis that brought the industry to its knees. By eliminating the 3 red lines, Beijing is trying to give developers more breathing room. Companies won't be forced to report monthly on their compliance with these debt thresholds anymore. The restrictions on how much debt they can take on are being lifted. In theory, this should make it easier for developers to access financing, to complete projects, to stabilize their operations. The hope is that this will restore some confidence in the sector. But here's where we need to talk about whether this is actually going to work, because I've got some serious doubts. First, let's look at the market reaction. Yes, stocks jumped on the news. Vanke up 10%, Country Garden up 26%. That's great for traders who got in at the right moment. But here's the reality check. Country Gardens bonds are still trading at around 8 cents on the dollar. 8 cents. That means investors think they're going to get back 8 cents for every dollar they're owed when this whole thing is done. That's not confidence. That's investors accepting they're going to lose 92% of their money. Second, removing the 3 red lines doesn't solve the fundamental problem, which is that there's too much supply and not enough demand. China built so much housing over the past 2 decades that many cities are drowning in empty apartments. Some estimates suggest that almost 1 in 4 apartments in China is currently empty. That's not because people are waiting for the right time to move in. It's because these units were bought for speculation and nobody actually wants to live in them or can't afford to rent them. The ratio of housing under construction to housing completed tells you everything you need to know about how bad the oversupply problem is. In 2020, this ratio hit 10.6 times. That means for every apartment that got finished, there were more than 10 still under construction. A lot of those are never going to be completed. They're just going to sit there, half-built monuments to a bubble that popped. Third, consumer confidence is absolutely shattered. Chinese households watched Evergrande collapse. They watched Country Garden default. They've seen their friends and neighbors lose their life savings on apartments that will never be built. Do you really think they're going to rush back into the property market just because the government changed some borrowing rules? Home prices are still falling. Why would you buy today when you think prices will be lower tomorrow? Fourth, the demographics are working against any recovery. China's population is aging rapidly. The working-age population is already shrinking. Fewer young people means fewer people forming households, which means less demand for housing. You can't policy your way out of demographic reality. Fifth, and this is crucial, local governments are in deep financial trouble. Remember how I said they depend heavily on land sales for revenue? Well, when developers aren't buying land, that revenue disappears. Some local governments are so cash-strapped that they can't fund basic infrastructure projects, let alone bail out failing developers. The central government has announced some support, like a program to swap local government debt for lower-cost financing, but that's designed to prevent defaults, not to unleash a wave of new spending. Sixth, the banks are in a really tricky position. They're sitting on huge amounts of loans to property developers, many of which are effectively non-performing. The official non-performing loan ratio for real estate has been creeping up. Banks know that lending more money to struggling developers is throwing good money after bad, but they also know that if these companies collapse entirely, they'll never get any of their money back. So they're stuck in this awful middle ground where they can't really help and can't really walk away. Now, let's talk about what this means for the global economy, because this isn't just China's problem. China is the world's second-largest economy. It's the biggest trading partner for dozens of countries. When China's economy slows down, the effects ripple out everywhere. Countries that export commodities to China, like Australia, Brazil, and Chile, see demand drop. Prices for industrial metals like iron, ore, and copper fall. Companies that manufacture goods for the Chinese market see sales decline. The property crisis has already had a massive impact on global commodities markets. During the boom years, China was consuming absolutely staggering amounts of cement, steel, glass, you name it. As construction has collapsed, demand for these materials has fallen off a cliff. This has put pressure on commodity prices worldwide and has hurt exporting nations badly. There's also the question of financial contagion. Global investors hold billions of dollars worth of Chinese developer bonds. When these companies default, those investors take losses. Some of those investors are pension funds, insurance companies, banks in other countries. The losses spread through the global financial system in ways that aren't always obvious or immediate. And then there's the broader question of confidence in China as an investment destination. If you're a foreign company thinking about investing in China, watching the government completely reverse a major policy after it destroyed an entire industry doesn't exactly inspire confidence. You start wondering what other policies might get reversed suddenly. You start thinking about political risk, and that makes you more hesitant to invest. Let's talk about what the Chinese government can still do to try to fix this mess, because eliminating the 3 red lines is clearly not enough. Some economists are calling for much more aggressive intervention. One idea is for the government to directly purchase unsold housing inventory and convert it into affordable housing or social housing. This would accomplish several things. It would take excess supply off the market, which would help stabilize prices. It would provide needed affordable housing, which is a genuine social need. And it would give developers cash to pay off debts and complete existing projects. The problem is the scale required would be enormous. The International Monetary Fund has estimated that stabilizing China's property sector could require spending equivalent to 5% of GDP spread over 3 years. That's trillions of yuan. The central government could do it. China's central government debt is relatively low compared to other major economies, but it would be a massive political and economic commitment. And there's real debate about whether it's the right move. Some argue that bailing out the property sector would just perpetuate an unsustainable growth model and delay necessary economic restructuring. Another option is much more aggressive monetary stimulus. The People's Bank of China could cut interest rates more dramatically. They could inject more liquidity into the banking system. They could use various credit facilities to push money toward property developers and home buyers. But here's the catch. When consumer confidence is destroyed and people expect prices to keep falling, lower interest rates don't always work. People still don't want to buy if they think they'll lose money. Some people are pointing to what happened in Japan after its property bubble burst in the early 1990s as a cautionary tale. Japan tried to deal with its crisis gradually and incrementally. They cut interest rates slowly over many years. They kept zombie banks alive instead of forcing restructuring. The result was decades of stagnation, deflation, and very slow growth. China really doesn't want to repeat that experience. But there's a key difference between China today and Japan in the 90s. China is still a developing country with relatively low per capita income. They have massive rural populations that could still urbanize. They have infrastructure needs that Japan didn't have. In theory, there's still room for investment-driven growth in ways that Japan didn't have. But whether China can actually tap that potential while dealing with this property crisis is a huge open question. Let me bring this back to what actually happened with the 3 red lines announcement. The government hasn't officially published detailed new rules yet. What we know is based on reports from state-affiliated media saying that regulators are no longer requesting monthly reporting on compliance and that the financing restrictions are being eased or eliminated. The details matter a lot. Will developers actually be able to access new financing at reasonable rates? Will banks be willing to lend? Will bondholders be willing to buy new debt issuance? These are the questions that will determine whether this policy change actually makes a difference. Early signs are mixed. Yes, stocks jumped, but bond prices for distressed developers are still in the basement. Credit rating agencies are still maintaining negative outlooks. Analysts are still projecting continued price declines and weak sales. Morgan Stanley just put out a forecast saying home prices will fall another 3% in 2026. Fitch is predicting drops of 4 to 6%. Nobody's calling for a sharp rebound anytime soon. What's really interesting is the government's messaging around all this. They're not celebrating or trumpeting this policy change. It's being handled quietly, almost sheepishly. That tells you they know this is an admission of failure. The 3 red lines were supposed to be this bold reform that would save the property market from itself. Instead, it accelerated a crisis that's still ongoing. Quietly killing the policy and hoping for the best is not exactly a confidence-inspiring approach. There's also a deeper question about what this means for Xi Jinping's economic vision. He came in talking about houses being for living, not speculation. He talked about common prosperity and reducing inequality. The property bubble was making a few developers and speculators incredibly rich while pricing ordinary families out of home ownership. The 3 red lines were supposed to be part of fixing that. But now, faced with the economic and social costs of the policy, the government has backed down. Does that mean the whole vision is being abandoned? Or are they just recalibrating tactics? I think what we're seeing is the Chinese government realizing that they can't afford to let the property sector completely collapse, even if they think it's too big and unsustainable in its current form. The sector is just too important to employment, to local government revenue, to household wealth, to the banking system. Letting it all fall apart risks social instability and economic crisis on a scale that's unacceptable. So they're trying to stop the bleeding first and maybe worry about reform later. But here's the brutal reality: time is not on their side. Every month that goes by with falling prices and weak sales, more developers run out of cash. More projects get abandoned. More families lose their savings. More jobs disappear. More banks take losses. The longer this drags on, the harder it becomes to fix. And we're already years into this crisis with no clear end in sight. What should you be watching for as this plays out? First, watch Chinese home prices. If they stabilize or start to rise, even modestly, that would be a genuine sign that confidence is returning. But if they keep falling month after month, that tells you the underlying problem isn't solved. Second, watch new home sales volumes. If people start buying again, that's real demand coming back into the market. Third, watch what happens with developers like Vanke. Do they manage to refinance their debt? Or do they eventually default despite the policy change? Fourth, watch local government behavior. Are they starting to sell more land? Are developers buying it? And finally, watch what the central government does beyond just eliminating the 3 red lines. Do they launch a major program to buy unsold inventory? Do they cut interest rates more aggressively? Do they inject capital into banks? The 3 red lines change is necessary, but not sufficient. The government is going to need to do a lot more if they really want to stabilize this sector. Looking at the bigger picture, China's property crisis is a warning about the dangers of debt-fueled growth models. For years, the Chinese economy was powered by construction and real estate. It worked brilliantly when the country was urbanizing rapidly and incomes were rising fast. But once you've built enough housing for everyone, and then some, continuing to build more and more doesn't make economic sense. It just creates waste and debt. China is learning that lesson the hard way. The transition from a real estate and investment-driven economy to one driven more by consumption and services is really hard. Japan struggled with it. South Korea struggled with it. Every developing country that gets rich enough eventually has to make this transition. For China, the transition is happening while they're still dealing with the consequences of a massive property bubble bursting. That makes it even harder. If I had to make a prediction, I'd say we're going to see a long, slow, painful adjustment rather than a quick recovery. Home prices in Tier 1 cities like Beijing and Shanghai might stabilize sometime in late 2027 if everything goes relatively well. But Tier 2 and especially Tier 3 cities, which account for 60% of China's GDP, are going to keep struggling for years. There's just too much oversupply, and not enough demand in those places. For developers, I expect continued restructuring, defaults, and consolidation. Some companies will survive, probably the ones with state backing or really strong balance sheets. But a lot of developers are going to disappear. They'll go through bankruptcy, liquidation, or forced mergers with stronger firms. The industry that emerges from this crisis is going to be much smaller and more conservative than what existed before. For Chinese households, the dream of getting rich through property appreciation is probably over for a generation. The era of buying an apartment and watching its value double or triple over a few years is done. That's going to have profound effects on behavior, on savings rates, on consumption patterns. It's going to change how Chinese people think about wealth and financial planning. For the Chinese government, this crisis is exposing the limits of their control over the economy. They can change policies, they can inject money, they can issue directives, but they can't force people to buy houses if they don't want to. They can't make banks lend if the banks think borrowers won't pay them back. They're learning that market forces are more powerful than policy directives, and that's a humbling lesson. The decision to drop the three red lines policy is significant because it shows the government is willing to backtrack when a policy isn't working. That's actually somewhat reassuring in a way. It would be worse if they stubbornly stuck with a failing policy out of pride or ideology. But the flip side is that it raises questions about the government's judgment. How did they not see that the three red lines would trigger a crisis? Why didn't they implement it more gradually? Why didn't they have better contingency plans? These are questions that Chinese policymakers are probably asking themselves right now. And the answers matter because China is going to face more challenges ahead. The population is aging, productivity growth is slowing, the U.S. and other countries are increasingly skeptical of Chinese trade practices, technology competition is intensifying. China needs smart, effective economic policy to navigate all these challenges. The property crisis has not exactly showcased brilliant policymaking. So here we are. The three red lines are gone, but the property crisis continues. Developers are still struggling, prices are still falling, consumers are still scared, local governments are still broke, and the Chinese economy is still facing major headwinds. Dropping the three red lines might prevent the absolute worst-case scenario of total systemic collapse, but it's not going to magically fix everything. What happens next depends on a lot of factors. Global economic conditions matter. If the world economy stays strong and China can keep exporting, that helps. If there's a global recession, that makes everything worse. U.S.-China relations matter. If trade tensions escalate, that's another hit to growth. Domestic policy matters. If Beijing implements major stimulus, that could help. Demographics matter. The aging population is a slow-moving but powerful force. For those of you watching from outside China, pay attention to this. What's happening in China's property market is one of the biggest economic stories in the world right now. It affects global growth, commodity prices, financial markets, and geopolitical dynamics. The decisions Chinese leaders make in response to this crisis will shape not just China's future, but the entire global economy. And for those of you in China watching this, I know this is an incredibly stressful time. Whether you're a homeowner worried about your property value, a home buyer worried about whether your apartment will ever be finished, a worker worried about your job, or just someone worried about the economy, these are real fears with real impacts on your life. The only thing I can say is that crises eventually end. How and when this one ends is still being written. The three red lines policy was supposed to be the solution. Instead, it became part of the problem. Now it's gone, and China is searching for a new path forward. Whether they find one that works remains to be seen. This is a story that's far from over, and I'll be here covering every twist and turn. Make sure you're subscribed so you don't miss the next chapter in what might be the biggest economic crisis of this decade. Thanks for watching, and I'll see you in the next one.